Hello, everybody, and welcome back to the Do Business Show. I'm Todd Frazier, and today we are going to talk about something that I get asked all the time. I get asked several questions, whether it's about taxes or business or podcasting or whatever the thing is. This is the one question that I get asked most often when it comes to taxes, and that is, Todd, how do I pay less taxes? Because that's what we really all want. We don't want to pay taxes if we don't have to, and we'd love to not pay any taxes at all. But the reality is, for the most part, you're going to pay tax on some level. You might see people or hear people say, I know that this person makes 8 figures and pays 0 in taxes. And I'd say that's a person that probably is going to get audited and owe a lot of money, or a liar, or both. I don't know. It really could be both. But the reality is, on some level, you're going to pay tax no matter what your income level is. Now, the people that I get this asked by the most are usually high wage earners, high W-2 income earners that are into $150,000 to about $350,000 a year in W-2 income, with not really any other deductions other than standard itemized deductions, which would be your home mortgage, your state and local taxes, which with the new big beautiful bill is going to be an increase from a $10,000 cap up to a $40,000 cap on state and local taxes, which that's a big win for especially people that own homes in the state of California, and high wage earners who pay a lot of state taxes. They're going to get a windfall there. But then beyond those items, your medical can be deducted once you get above 7.5% of your adjusted gross income, which you have to pay a lot in medical for that to make sense. And then the other option is charitable contributions, which you can give up to 60% of your taxable income in charitable contributions in a given year. Now, that also means that you're giving away money, which generosity is great. I give money away to our church and to other charitable organizations. I think it's a great thing to do. If you're wanting to save taxes by giving 60% of your income away, then I have other options for you. That would be helpful. But realistically, those are the things, other than maxing out your retirement contributions, it's itemized deductions. If you're just a W-2 wage earner, some people talk about having real estate. Well, if you're not a realtor, you're not in the business of real estate, you're limited on your losses. So that is another way that you can save taxes, but really it isn't a huge impact. The thing that I find for most people that makes the greatest amount of impact on saving taxes actually might seem counterintuitive. And it is starting a business. Stay with me. Starting a business allows you to deduct expenses that you wouldn't otherwise be allowed to deduct. For instance, if you're a W-2 employee, there is no longer any deduction for work use of your cell phone or mileage for salespeople, or if you're paying for things that you are not getting reimbursed by your employer for, you can't deduct those. You used to be able to deduct those on the miscellaneous itemized deductions on your Schedule A, but that no longer exists, which it was impactful, but not really to a really high level. But when you have a business, you have something that you are working towards making money and ultimately building wealth. And that's the other side of this that I want to talk to you about. But the first thing is you get to save taxes because, for instance, your cell phone that you have, that we all have, you have to have that for a business if you're running a business. The cost of that is deductible. The cost of buying the cell phone, the cost of using the cell phone, so your cell service, your computers that you use for the business that you run are deductible. All of those things that you might use on a personal level and bring you personal enjoyment. For instance, I'm recording this podcast as marketing for my business, but I own the cameras and the lights and the microphones and all the things that I'm using to record this podcast. I bought those in my business and I deducted those. Now, if you just think about that and say, well, this is great, I can spend money on things and it can reduce my taxes. Yes, but the IRS says that anybody who is running a business has the intent of actually making money. Otherwise, it's a hobby. So in theory, you could start a business, have all these expenses that are business related and write them off. But if you are not intent on actually making money at some point, then the IRS says, that's not a business. That's a hobby and a tax loophole that you're trying to take advantage of. So we're not going to let you include any of those deductions, but as a hobby, we're going to make you pay tax on all the income. So you have to be very careful from a Schedule C standpoint. So if you're an individual that just wants to start a business and you don't want to open any entities, which you shouldn't at the beginning because they're expensive and the cost goes on forever, which we'll talk about in a second, you can just start a business. If you have things lying around that you can sell, you have old glasses or things that you want to sell in your business because you're going to do it on eBay or Etsy or Facebook Marketplace or whatever platform you want to sell items on and receive money, that's a business. It can be as simple as that. It doesn't have to be extravagant. You don't have to go out and start some extreme type of business. It literally can just be, I'm just selling stuff around my house. That's a business. If you are receiving funds for goods or services, that's a business. Now, inside of that, the structure to set that up, there are several different entities and ways to do it. One is just to start a business as an individual. It's called a sole proprietorship, and you would run a Schedule C on your 1040 tax return. And you would get to deduct all the expenses that are related to your business as long as you have some level of income. Now, here's the catch for Schedule C for individuals. It doesn't cost anything to start the business. You don't have to go out and create an LLC or even get a tax ID number, which you can get a tax ID number if you're an individual that's starting a business as a sole proprietorship. I recommend just go to irs.gov and apply for a tax ID number so that when you're requested to send a W-9 for somebody to send you a 1099 on income they gave you for the year, you don't have to put your social security number. You just put a tax ID number. You're only allowed one tax ID number per your social security. So if you've already got a tax ID number from way back in the day that's tied to your social security number, you can use that and just start the business. And then the business is running and that's it. There's no cost for that. The IRS gives you a tax ID number for free. I'll say that again, for free. And then you can use that, start your Schedule C business. For the IRS, they're saying, look, we get it. It costs money to run a business. It costs money to start a business. And not everybody is good at business. So we understand you might lose money. You might not have a big net profit at the end of the year, and we don't get to take taxes from you. Oh, that's such a bummer, and it reduces your taxable income. However, they do say, theoretically, if you're running a business, your goal is to, as we said earlier, make money. So in a 5-year period, you can have losses for 2 out of those 5 years, and we're okay with it. Which meaning for 2 years out of 5 years, you can have big losses, major losses, as long as they're legitimate and they're related towards building a business or running a business, that's okay. But as soon as you get to year 3, you better break even or make some money because the IRS then has the right to come in and say, hey, you lost 3 years in a row. We don't think you're actually running a business. So as I said earlier, we're going to treat that as a hobby, which means we're going to tax you on all of the income and not let you deduct any of these expenses. That's really bad. You don't want that to happen. So the rule for a sole proprietor that's running a Schedule C business, you can only have losses for 2 out of 5 years. So what does that mean? Does that mean that I can only have 2 years of losses? No. It means you can have 2 years of losses, and then you have to have 3 years of being even or making a gain. I always recommend that you have at least some sort of gain in those other 3 years so that then after those 3 years, then you can have a down year. It happens. It happens in business. You're always up and then sometimes you're down and it changes. But as long as you have a legitimate purpose for running your business and you are legitimately having expenses against that business, it's deductible. You can have a loss for 2 years out of 5. The next thing you'll hear people say about running a business is, well, you got to open an LLC. Have you opened an LLC? Do you have an LLC? Do you have an LLC? I have an LLC. You should have an LLC. LLCs aren't magic, and I don't understand why people talk about them all the time. It's kind of a catch. Well, I tell you why is because people will charge you for setting up an LLC. They will take your money and set up an LLC even if you don't need it. Let me tell you why an LLC may not be something that you want to open. First of all, it's going to cost you money, even if you do it yourself. You go to LegalZoom, or some other website or platform to set up your LLC, there's a fee there. There's a cost for the platform to do it for you. And then depending on what state you're in, there is usually a cost in that state to set it up. For instance, I'm in the state of California, and I believe to set up an LLC, it's either $400 or $600 to set it up. And then every year you owe what is called the franchise fee. And it is $800, whether you make money or lose money every year in that state. In the state of California, it's $800. So right off the bat, you've got a cost. Let's say it costs $200 through LegalZoom. Maybe you can get a $99 special or something like that. So that's $100 plus the fee to the state of California to process the paperwork. So let's be generous and call it $200 or $300. You can look it up. I'm not going to do it right now. I don't want to take too much of your time. And then you pay $800 to the state of California every year. So right there, you're already in for, let's call it $800 to $1,100. Now, the state of California franchise fee is deductible on the federal return, but not on the state return. The cost for setting it up from LegalZoom, that is deductible. But then you're locked in every year and you have to pay $800. And here's the worst part. If you have an LLC and you're just a sole member of the LLC, it is treated for federal purposes as a Schedule C business. And therefore you pay self-employment tax, which is 15% on top of your net income. So if you make $100,000 in total revenue and you have a net profit of $50,000, you're going to pay income tax on that $50,000 after whatever your other deductions are on your tax return. Plus, you're going to pay self-employment tax of 15% on top of that $50,000. So that's the trap that you really get into of if you're running a Schedule C business that's profitable, you could be paying more taxes. Now, you've got to do some calculations to see if that makes sense for you to run a business at that level as a Schedule C. What I usually recommend is once you get to the point of around $100,000 of annual revenue is the place where I start to say, hey, let's think about an entity, whether that's an LLC or an S Corp or a C Corp, which I rarely recommend C Corps. That is typically the place where it starts to make sense. The cost of running a corporate tax return, because if you are running a partnership LLC, or I should say a partnership or an LLC with no S Corp status, that's taxed as, it's taxed the same as a sole proprietorship, and you pay self-employment tax on the net income. However, if you have an LLC, you can elect to be taxed as an S Corp, a small corporation for tax purposes. It doesn't change the entity. So you have an LLC. LLC is a lot easier to set up, a lot simpler to run. You don't have to have all the board minutes and meeting items that you have to have for a full corporation, but you can still get the S Corp status for tax purposes. Here's the benefit of having an LLC with S Corp status. This is the only time I start to recommend LLCs for people. If you've reached that $100,000 threshold of gross revenue and you've got a net income that's coming in around $40,000 to $60,000 a year or more, then you're going to really benefit from having S Corp status. You may ask, well, why is that? Well, the reason is S Corp earnings, net earnings, pass through on what's called a K-1 to the owner, and it shows up on your 1040 tax return as investment income, which is not subject to self-employment tax. So you take a reasonable salary from your corporation that is based on industry standards, whatever that number is, and then any net income above that gets passed through and you pay no self-employment tax. So now you can really start to win. You might start thinking, well, Todd, you were talking about saving taxes. Why are we talking about net income and earning more money? Because the reason that you would start a business is not just to save taxes, because it's a lot of, unless you just really love it. And I love business. I love running businesses and talking about business. But if you really, really are interested in longevity of wealth and you're interested in tax savings at the same time and being able to use the tax code to benefit you, then running a business makes a lot of sense. I saw this graphic the other day, and it's on social media. So how much weight you give to it, that's up to you. But I think the concept is right on. So this right here is somebody inspire Oasis. I have no idea who this is. However, the concept of what he's saying is why most employees never get rich. Now, your definition of rich is probably different than my definition of rich, which is probably different than somebody else's definition of rich. But most employees will never get rich because 74% of the world's richest people are entrepreneurs. Think Elon Musk, think Steve Jobs, think Jeff Bezos, all the big names that you think of. They're entrepreneurs. They started a business and they started running it. 12% are full-time investors. Warren Buffett, those guys make a lot of money. And a lot of people can make money just being investors. 8% made it through sports, meaning they have a talent that they were able to monetize and make lots of money. And 4% through entertainment or art. Now, I don't know that these percentages are accurate. I don't know that I trust anything on the internet anymore, unless you're watching me. You should trust me on the internet. But the concept, I think, is accurate. As an employee, you're just getting W-2 wages. You're not getting a benefit at the end of the day or what the company does. Now, maybe you have a bonus or a profit share plan in place that you do get some of that, but that only lasts as long as you're an employee. When you're building a business, you're building an asset that eventually could give you dividends down the road. It initially is going to give you a tax savings, but down the road, it should be a vehicle to get to where you define rich as, or where your wealth gets you to a place where you can be comfortable. Now, is that the goal of everyone? Absolutely not. Do I think that everybody can run a business? Yes, I think everybody can. It's not extremely difficult, but it does take effort and you have to want to do it. Do I think everybody should run a business? Absolutely not. I believe there are people that are employees, and that's totally fine, nothing wrong with that. And I believe there are people that are business owners, and I think there's nothing wrong with that. That's totally fine. There are people that I think land in the middle. But if you're going to run a business, there are certain things that you have to do. You have to work hard. You have to stay late sometimes. There are things that you have to do to focus on to make it grow, just like you do with anything. Hard work makes the world go round. But I will say, if you're looking at it from a tax savings standpoint, it will start as a tax savings. Eventually, it will grow into a vehicle that will cause you to get to the level that you want to get to. Where did we get off on this? Well, now you talked about saving taxes, and now we're talking about growing a business. Because it's all tied together. The reality of what I see when I do taxes and I talk to my clients, and they're high W-2 wage earners, and they just want to figure out how they don't have to pay 30, 40, 50% in income tax, it's have something else. Have another option, whether it's investing and you do well in stock markets or crypto. I mean, if you're doing something like that, that doesn't necessarily save you in taxes, though. That helps build wealth, but it doesn't save you in taxes. If you have a skill or you have knowledge and you have something that people are willing to pay you for, or you have stuff, you have things that people are willing to pay you for, you can start a business. You can start a business today. You don't have to go and do some fancy setup and create the LLC or create the corporation and then apply for small corporation status for tax standpoint. You don't have to do all that. You can just have a skill or a product that people are willing to give you money for. Goods and services exchanged for cash. That's a business. Congratulations, you're a business owner. The advantage, especially for at least 2 of the next 5 years, if you're just going to do a sole proprietorship, if you happen to spend more money than you make, you get to deduct it on your taxes. That's a good thing. The IRS code says anything that is reasonable and ordinary for a business owner to operate their business is a legitimate deduction. So think about that. What are the things that are legitimate? I think today in 2025, a cell phone service, a computer, probably a car are the most essential things to running a business. There's other things around that, space to do it, a desk, obviously. But the biggest high ticket items are things that we have every day. I have a client that is in Alaska, and I would travel to Alaska once a month for a week the last 18 months. I'm not doing it anymore. It was fantastic. I enjoyed it. I got the benefit of writing off that expense and the benefit of the miles from going there. And I got to use them for a bunch of personal stuff and fun trips that we went on in Texas this summer with my family, because it was miles that I got to use to go do fun stuff. There's lots of other benefits along with having some sort of vehicle that allows you to spend money on things that could make you money, all the while giving you tax benefits at the end. All right, so the last little caveat that I want to give you about this, this tax savings and wealth building strategy is this. I told you at the beginning, if you're a Schedule C, if you're a sole proprietorship or a sole member LLC, you have a limit on your losses, 2 out of 5 years. That's what the IRS says. If you're an entity that is treated as a corporation for tax purposes, that 2 out of 5 years loss rule goes away. Because there's all kinds of ways that corporations will be down for several years and then make a comeback, or they'll have suspended losses or things like that. So if you're in the situation where you're going to invest big time in a business and you really see the future of that in the next 3, 5, 10 years, you can take advantage of the expenses of getting that going if you just go ahead and create the entity and you convert it to an S Corp for tax purposes, and then you get away from that, I can only have 2 years of losses. Now, again, this all has to be legitimate. You really have to be operating a business with the benefit of potentially growing in the end. Some people are just bad business people. I get it. I've seen people that have just tried, they tried for years to make money in their LLC or S Corp, and they just can't seem to do it. But they get to deduct the losses. I'm just saying, guys, there's lots of things in the tax code that can benefit you. And I think that the best way to do that is to start a business. Start a small business. You don't have to go big. Whatever product or service that you have that people are willing to pay you for, you started a business. That's it. You have knowledge about how to fix somebody's calendar on their phone, or you have knowledge about exercise and you can teach exercise classes. You can be a fitness trainer, any of those type of things where people are willing to give you money. A YouTuber. Hey, you could be on the internet. You could have a podcast. People could pay you for podcasting. You never know. It is a legitimate way to make money, which means the IRS says that could be a business as long as you're doing things that work towards growing a business and it's legitimate. That's all I have to tell you. If you want to save taxes, you can maximize your 401ks. You can maximize your itemized deductions with mortgage interest and state and local taxes and medical if you can get there, and charitable contributions. But I think the most advantageous way for you to save taxes while at the same time putting a vehicle in place that will build wealth is starting a business. If you haven't done it yet, I think you should do it today or tomorrow or maybe this weekend. Maybe, think about it. But don't wait too long, because I think there's opportunity around the corner for everyone if you choose to accept it. So go and do business, because that's what this show is called. And I love doing business. I like it a lot. So thanks for hanging out. Thanks for checking out the show. Make sure to like, subscribe, follow whichever platform you're on, whether it's Spotify or YouTube or Apple Podcasts or wherever you're listening or watching this. Also, would you share it out? If you have somebody that has said, man, I just pay too much in taxes, send them this episode. They might find it intriguing. You never know. With that, that's all I got to say. And I'll see you on the next episode. Bye.